Joining us tonight, we are here with Dimitri Pargamonic. I'm going to duck down real quick. Read that disclaimer. I'm like,
hey everyone, thanks for joining us.
Yep, we're going to be talking about benchmarks tonight. Let's go through a little of the ground rules, Dimitri. First of all, leave your question and answers in the bottom. Also in the chat, it's open. Ask me anything in the chat, but if you want a question for Dimitri at the end, please leave it in the Q&A. If you're on YouTube, put it in the chat and I will get it to Dimitri at the end when we go to the Q&A. Also, if you're in YouTube, please hit the subscribe button and subscribe to all of our videos. Dimitri puts out 2 or 3 a week that are very educational. So with that, first, anyone in the chat, make sure you can hear us. Dimitri, can you hear me?
I could hear you fine. Can you hear me, Will?
I can. It's perfect.
Okay.
All right.
Just let me know. Am I sharing the screen right now, Will?
I see. Let me take a quick look. Yeah, I see. It looks like the SPY is up there. Is that correct?
Yep.
Perfect.
Okay. Awesome. All right. Well, everybody, thanks for joining us. And really, if some of you, maybe you already caught, like when I was on the Benzinga show, it's a little bit of a recap and just a follow up on what we did there. And we talked about option strategy benchmarks. And really, you know, when we started doing these, and we just released them like a week ago. And really why we did that was I got a lot of questions on calendar spreads and diagonal spreads. And that's when we started looking at how can we help out with people who are trading calendar spreads, diagonal spreads, and then it kind of expanded to butterflies and all the other strategies. And the idea behind it is the following, that when you're trading options and typically what you're looking at is, well, how am I going to tell if the options are expensive or cheap? And you look at the implied volatility, obviously, and you'll say, well, implied volatility is elevated. Options are expensive, implied volatility is low, then options are inexpensive relative to historical levels. And that's fine maybe in general terms. So you got a general idea like options are expensive or they're cheap, but it doesn't really help you once you start trading strategies, right? So and here I have an options chain, I put it up here. So just if you take a look, over here are the strikes, here I got the calls and the puts, calls on the left side, puts on the right side. And you could see here that every option itself has a different implied volatility, right? So you could see here the 302 call, that call is a 19.9 volatility. If I go up to the 308, that's 18.1 volatility. Sorry, if I go down, you could see that the volatilities here are even higher. And that's what we call skew, right? So we don't actually see the same implied volatility going through all the strikes. And that becomes important, especially if you're trading one option versus another. If you're buying one option versus selling another, well, where is today's relationship versus historical levels, right? Is the skew very skewed high one way, or is it below? So I'm going to show you how to look at that, but that becomes very important when you're trying to trade one option versus another, like a put spread, for example. You're buying one put, selling another put on a different strike. Besides the skew within the strikes, what do we also see is here are all the different expirations, right? So I'm looking at SPY, and you could see this one expired starting May 27th. We got a 19.2. And then you could see I'm going June 5th, 21.4. And as I go out further, and this is what you typically see, is that the implied volatilities will increase. And the reason for that is it slopes higher because the further you go out, the more uncertainty there is. So the implied volatility is usually skewed higher, or it slopes higher as you go out further in time. Well, if you're doing a calendar spread, that's important. If you're buying an option in one calendar expiration and selling it in another one, well, how are today's relationships versus historicals, right? Should you be buying the near month, selling the far month, or the opposite way around, hoping that as time goes on, they revert? So that's kind of the gist of why we created benchmarks to help you out with that, because right now you kind of have one benchmark, is the 30-day implied volatility high or low. And so this is what the benchmarks will look like. I'm going to come back to it. And the other reason we did these benchmarks is because a lot of people were asking questions. Well, can you show different strategies? So these are different option strategies. And you could see here are the payout diagrams, what it looks like at expiration. And so depending on your outlook, you could use different option strategies, right? Here's a straddle if you're looking for a really big move in either direction. Here's a strangle, call spread plus, so you could kind of just go through it. And if you have a particular outlook, you could find that strategy that kind of fits that outlook. And then you'll be able to look at that benchmark and see, well, am I getting a good deal or not such a good deal relative to historical levels? So over here, I'm just going to take this first one here. And this is a risk reversal. And what this in SPY, and what this is doing is it's benchmarking on a 30-day maturity, right? So if we had a constant 30-day maturity, just like the VIX, and if we bought an out of the money call 5% above the at the money, and we sold an out of the money put 5% below the at the money, what would that cost us relative to the stock price? So over here, we see like today's, we would receive a 0.7% credit relative to the stock price. So think of it in terms like this. If SPY, was 100, the call would cost me 30 cents. The put I could sell for $1, so I collect 70 cents. That's 0.7% credit. And here you could compare it to historicals of negative 0.5%. So you could see it's a little bit higher than the historical levels. And if you wanted to go, if you click here, and you could look at different maturity dates, but here's what it looked like over time. So you could see here, lately it's been that credit has been higher than usual. So it's one way to even consider if I wanted to get long the market, use the risk reversal. I'm actually getting a little bit extra than historical levels. So that's kind of like how you would look at it. So let's just go back to the options chain really quickly, and I'm going to set this up. So over here, I'm right now on the June 5th expiration. So let's see how this would look like. So first, I'm just going to pick one option here. Let's say 5% out of the money. So I'm going to go, you see here, 5%. Let's see. So this is the closest one, 5.1%. That's the 314 strike, 8 days away. So if I click on this, right now it's 26 cents. I'm going to run this. So really the first thing I want to know is, well, using historical implied volatilities, what's the average price of this option usually? So this is what we're going to do. We're going to go here on the IV Theo, and here it goes back every day. So you see every day it logs an option with, 8 days to expiration, 8 trading days to expiration with 5.1% out of the money, right? So we're looking at every day logs in an implied volatility for this option, and it creates a theoretical value. So we could see here every day. So on average, that average value over time was 21 cents. Today it's 26 cents. And we could kind of see the high and the low. So we see even here a 0. So when the implied volatility was very low, these even were worthless. So here you get the range, the average, and what it is today. So now you have a reference, right? A frame of mind, like how high that option is versus historicals. But let's say we want to now do that risk reversal, right? So the next thing is, well, what if we sold an option against it? And a lot of times when you're a trader, you're buying and selling options, creating spreads because you want to hedge that Vega risk, right? Because if you just buy options, you're exposed to your Vega risk. Or if you just sell, you're exposed to Vega risk in addition to the gamma and theta risk. So let's just go do that risk reversal on June 8th, and I'm going to go 5% out of the money here. So here's a 5% out of the money, 284. Let's sell that. So here I'm going to rerun that strategy. So this is how the strategy looks like at expiration. So see all this green, since we're getting a credit of 93 cents, right? As long as that as long as the stock expires above that short strike 284, we keep that credit. If it breaks to the upside, then breaks through that upper strike, at expiration becomes 1-to-1 with the stock. If it breaks the downside, obviously 284, then it becomes 1-to-1 to the downside with that stock. So this is what it looks like. Let's take a look historically what levels it traded at. So I'm going to go here to the IVTO, right? And here, so today we're getting a credit of 93 cents. Historically, the average credit was 40 cents. So it's like the market today is paying you an extra 53 cents, right? That's how you look at an extra 53 cents above the average levels. And you could see here the high and the low historically, and then you could come here and take a look, day by day where those implied volatilities were. So that's how, and this is like here, that's today's 93. So we could see here on Friday, it was negative 107. So it's actually trending a little bit lower. Now that if you saw, so this is an example inside the same expiration, right? So here, if I'm buying and selling an option inside the same expiration, you could do, I just showed you a risk reversal. Obviously, you could do this with call spreads, put spreads, or, up to 4 legs within this expiration. But let's do a calendar spread. The calendar spreads are kind of interesting because here's the idea. Let's set this up, and then we're going to look at how we think this calendar spread will pay out. So let's start out with, I'm going to buy an at the money strike in SPY. Let me see, around the at the money 299 with 8 days to expiration. And I'm going to come out here and let's just go out to let's go to July 17th expiration. And what I'm going to do is I'm going to sell an option, but I'm going to do a diagonal. So I'm not going to sell an at the money. What I'm going to do is I'm going to do a diagonal, and let's just say I want a credit. So I'm going to sell something above $4.48. So let's just sell this one, the 305 call. So let's see what this looks like. So this first chart, this is what it would look like at this June 5th expiration. Obviously, July 17th, these options will not expire yet. So this is using June 5th expiration, the first expiration, and then it's assuming that the implied volatility is the same, 22. But let's take a look at it historically, like, is this a good do or a bad do? And what would it look like, after expiration, with July 17th? So here's the implied volatilities here. So we can see here that today we're getting a credit of $2.29, right? So this is the pay. Right now we're getting a credit of $2.29. We're buying one for $4.48. We're selling one for $6.77. And notice this, that based on when you're doing this diagonal, what you want is a lot of movement, right? You want it to move very far away from these prices, especially because you're receiving a credit at expiration. The reason is that the further away it is, the more in the money or out of the money they are, and the less time premium there is because you're receiving a credit. So you want very little time premium left in both these options. Or you want the implied volatility in this front month to go down because you're short Vega. So let's take a look at this IV here. So today we're getting a 229 credit. On average, that's on average it's worth 0, right? No debit or credit. And here's the high and the low in the last 4 years. So let's take a look at this payout diagram. And what this payout diagram is doing is saying, well, let's fast forward to expiration and put in, what is this option, whatever this July 17th, right? In 8 days, right? It will have, instead of 37 days, it'll have 29 days. So where's the implied volatility with 29 days to go? So if it reverts to its median volatility, that's what this looks like, right? Let's say the implied volatility is a little bit higher, 70th percentile, we could check that. So you could see here, even in the 70th percentile, this is looking pretty good. If it's like in the 80th percentile, still looking pretty good. So you could kind of get a sense of, hey, if there's a lot of movement in the stock, or if not a lot of movement, but those implied volatilities start reverting back to normal, this is what that payout diagram looks like. So that's why it's very important. So over here, what we did was we constructed our own strategy and tested it out. But what we did was at first, we just used benchmarks to say, well, how do they, how do these line up if I want to do anything? So here's a ratio call spread. So we can see on a 30-day, today it's a 1.5 credit versus average of negative 1.2. And you could go through any of these depending on your outlook. Here's a calendar spread. And that's like your starting point. So you could really quickly, just like the VIX, you could say, how did the calendar spreads line up today? And then here's a 30, 60 day. You could go really quickly, scan through it. And then if they look good to you, then you could go to that options chain and construct your own using your own strikes, right? Based on your own outlook where you think the stock might be. So that's kind of like a recap of everything we did on the Benzinga. I didn't take any questions on the Benzinga, so I kind of wanted to leave it more today. So Will, do you have any questions?
We do have quite a few.
Okay.
How was it on that Benzinga episode, by the way, before I get to the questions?
Yeah, I thought it was good. I talked to Benzinga, like they were pretty happy. They're doing an article actually on that show. So there'll be an article on Benzinga on these benchmarks actually. I saw like a rough draft of it. And then I'm going to be back on that I'm going to be back on the Benzinga show. I have to go and I didn't settle on a scheduled time, but I should be back like maybe in like next 2 or 3 weeks. So
wow.
So that's pretty cool.
That's awesome. First question actually was asking, do you have a link to the Benzinga recording? I'm assuming we can get that and maybe send it out to people. Is that possible?
Yeah. I mean, it was pretty much kind of like what we did today. It was a little bit more of a presentation. I had like slides there. I didn't do the slides today, but I think maybe we could, it's on the Benzinga YouTube channel. It's like their pre-market. I forget what was that day. It was last Thursday.
Yeah. Well, also there was an email sent out by us. So if you just search the emails from Market Chameleon.
Yeah, so it was on their morning show from 9 to 9:30.
Just search your email for Benzinga Market Chameleon. You'll see an email from us with the recording.
Yeah, if not, just email us support@MarketChameleon.com. I'll find the link and
all right, cool. Mike Chandler asks, and he's somewhat making fun of me, but he's asking about risk reversals. Is there somewhere where there's a list, or is it something that could be built where it shows risk reversals that are maybe, looking more favorable? It was the question. We don't have anything like that, correct?
Right, like a screener.
Yeah, like a screener.
So we didn't do a screener. Yeah, we didn't do a screener yet. We're kind of like, this is the first time we even rolled this out. We kind of just made it even like available to people because, it's new. We wanted to see like, people get used to it. And I think also that I wanted to see, people have been asking a lot about just in general, option strategies to like payout diet. So over here next to each one of these strategies, if you click here, it'll take you to another page which kind of explains a little bit in more detail about the strategy and what are the legs and the payouts at expiration and kind of like when would you want to use them. So we don't have like I know where Mike's saying like if you could screen out the best ones right now, we didn't get that far. We kind of just rolled out this first version. But I know Mike, Mike asked this before because I know he looked, I think when we did a risk reversal, I remember because I talk a lot to Mike, he's like one of our like longest and
well, he's one of the top chameleons for sure.
Right. So I know like with the risk reversal, you do have unlimited down, because you're selling a put, you have unlimited downside risk because once it breaks your put, it's like 1-to-1.
Just like owning the stock, right?
Like owning the stock right after that strike. So here's a double bull. So this is kind of like, this is a little bit like a risk reversal, except not exactly, because you're actually stopping out. So what this is doing is you're buying a out of the money call spread and selling an out of the money put spread. So instead of buying a call, selling a put, you're buying a call spread, selling a put spread. But this way, you're capped out to the downside and to the upside. So over here, you could see here how they line up, today. So over here, this is an out of the money call spread, 2%, 5%, out of the money put spread, 2%, 5%. So you could really quickly just get a sense of where those skews are trading today relative to the historical levels, right? Because the skew, think of it as like, it's kind of like, it's kind of like a wing flapping its birds. You're going to see it. You're going to see those implied volatilities move around, but usually they'll go back and forth because those options are related, right? They're still somewhat related, but we do see a skew. So, you're not going to see them just straight implied volatility down.
Very cool. Very cool.
Yeah.
We have a question, and I'm going to try to interpret it the best I can. He is asking, and I'm almost 100% sure we don't, but I have to go to you for clarification. He's asking, do you have a way to algorithmically recommend the best outlook and corresponding strategy to use? So I guess if you're bullish in outlook in the stock, there's no way to pick the best corresponding strategy, is there?
There's no best corresponding strategy because it will depend on your, just your risk tolerance and what you want to do. Like you could see here, some people might go for a risk reversal, and I just showed you an alternative, like a double put spread, right? Some people want to just sell puts, some people do put spreads. So I can't say this is the best strategy, but what we do is, when we line up the strategies, we look at what we think the theoretical values are versus the market prices. So you could kind of see the best theoretical edge, right? So that's one way to compare them. Like how far away is the market prices in this strategy diverging from its historical mean, and how far away is that strategy, and what are the historical win rates? So there's there's never here's just this one best, because that one best will really depend on your risk.
It depends on each individual's risk tolerance,
what they want to do, right?
What they want, how much. I mean, obviously everything should be, trade small. It should be a small piece of their portfolio, and
right. It's laws of large numbers,
yep.
And and it's kind of like, think of it this way: you could make a comparison. Let's say you're investing in real estate, right? And you're looking at different properties with different cap rates, right? So this house is 100,000 and it has $10,000 in rent per year. That's 10 cap. Here's another house, 100,000. It has 8%, $8,000 in rent a year, 8 cap. So if they're exactly similar and equal, then you'll know that the 10% cap is better. But then you have to but maybe one is in, who knows, like a better district, or where there are more jobs, or something is happening there that, is a little bit better, and that might just justify the difference as well. So you might even perceive one less risky than another.
Very, very cool, D. All right. Mike Chandler is asking, he wants to see, if you were bullish on a stock, could you walk through how you would use the benchmarks, the spread screeners? He just wants to see how Dimitri would do it. If there was something, I mean, it's hypothetical, right? If you liked either a benchmark or an individual stock, he wants to see how Dimitri would walk through the chameleon.
So and so I'm just going to kind of look at from a perspective of just I'm bullish, right? So I'm bullish, and maybe then I would also think how much risk do I think on on the downside is there today? If I'm risk averse, then what I would probably do, here's a double bull spread, because I know that here I got defined risk to the downside, right? Maybe I would go and look at a puts debit call spread. How much would a debit call spread cost me? 2.1 versus 1.7%. So I know I'm paying up a little bit, 0.4%. This is a 5% call spread, right? From the out the money, 5%. Maybe instead of that, maybe I would sell a put spread. Maybe instead I'd take a 1.3, take in 1.3 because it's a little bit higher than the average. So instead of buying a call spread, if I'm feeling like, hey, I'm bullish, but it might just sit here, so this one is actually buying a put spread, but I would be doing the reverse selling it. So it would look the opposite way like this. So I would kind of just look at what is my outlook and where the options line up, and I would just kind of go through like what are some of these spreads, how do they line up, and what do I think is the best one relative to historical levels. If I thought implied volatility was going to go up, I would do something different, maybe a calendar spread. So probably like in today's market, I was looking at more of the calendar spreads and diagonals. That's kind of interesting because if the market moves up, well, let me take a look. So let's see.
What they want to see. They want to see you taking a look.
So here's a diagonal spread. So this would cost you, 1.2 if you bought that at the money, 30-day, sold 5% out of the money. So these are kind of in line. Here's 30-day, 90-day. Maybe this one would be interesting, and I would try to put it on for credit. So something like that, maybe like a 30-day, 90-day, because you would want it to, if you put it for credit, this way it looks green, and then actually it'll start looking green the other way if you put it in for credit. So even if you have a big drop, as long as you do it for credit, you'll keep that, you'll keep that difference.
Yeah, that's great. We have a question from YouTube, benchmarks. I mean, they're asking, and QQQ, SPY, they're saying if they want to look into one of these indexes, how do they find the makeup of the index?
So basically this is the general, when we're looking at this index, this is the diagonal call spread. What it's doing is saying, if you're buying the at the money call, 30-day volatility. So we're looking, so remember when we're benchmarking, right, we have to create a constant maturity, just like the VIX is a 30-day constant maturity, right? So we're looking at 30-day constant maturity here. Here, this is a 60-day constant maturity. This is comparing the at the money. This is comparing the 5% out of the money call. So that's the benchmark, right? Remember, there's no actual 30-day option every day, right? We don't have that like every day a 30-day option. So just like the VIX is calculated, you're taking the weighted average between the two months that straddle 30 days, the weighted average between the strikes that are around the at the money, and every day you're calculating that to get a constant maturity. That's why we're benchmarking it, right? It's not like you don't have that actual option every day.
Gotcha. Excellent. We have a question from a relatively new trader, and he's still watching, trying to learn. He's asking, what would Dimitri recommend for basic study to get in from the ground floor to start understanding options?
Ooh.
Nattenberg, go to Nattenberg.
Yeah, I mean, there's a lot of education out there right now. It depends. Like I know that like the Options Industry Council, they give you free education. So they'll, let's see if we could find it.
The OCC is a good one.
Options Industry. Yeah.
I'll put that link out. I got it.
You have it. Yeah.
Yeah.
So let me see here. Where is it? Did I misspell it? Oh, here it is. So OIC, this is supported by the industry. All the exchanges kind of funded, and then so this is like a free resource. I think you could like but they start you like right from the beginning. I think they have like webinars and stuff, protective put strategies. So they do give like a lot of free information here. I think that this could be helpful to start reading, and they could point you in the right directions. There's a lot of stuff on YouTube as well, like to learn from.
I would say the 700 videos we've put out is a pretty good place to start as well.
Yeah, I mean, yeah, it depends on what level you're in,
That's
but
true.
I would say get to, at least if you're learning, before you do anything, like get to the level where you feel comfortable vertical spreads, right? Like I would say until you feel comfortable verticals, because the easiest thing, like what people do is they'll learn what a buying a call, buying a put, right? That's the first thing they learn, and then they'll jump in because it's simple and they think it's easy, but it's very tough to be successful just buying calls or buying puts. It's actually because people don't realize like there's decay, there's vega risk, there's lots of risk with it, and it's very tough. So I would say just keep learning until you feel very comfortable with vertical spreads. I would say don't stop learning. You're probably not ready yet.
Great advice. Someone is asking, this is Jack. He's asking, he wants to know could you walk him through how to get to your screen? So he lands on our homepage.
Yeah.
Can you walk him through how to get to the screen you were doing your demo on?
Sure. So like, let's say you're just, I'm going to just start out from the homepage really quickly. So over here, you could just go to you see up here, you could just type in any symbol, SPY, right? It'll take you to this screen here. And when you hit on options, here's the options chain. Here are the strategy benchmarks. So the options chain is the first one, strategy benchmarks is the second one. And that's where you'll find it.
Excellent.
Yep.
All right, here's one from Gary. He's asking, show best only tab, best cushion, best Theo, best win rate. So if you were looking for something with the best win rate, maybe best Theo, like a screener, is there a way to screen by win rate? That's what Gary's asking.
Right. So this is benchmarking costs, not win rate or outcomes. I know what he's asking. He's asking about our like screeners. This is a little bit different. This is just looking at, if you did it at today's prices at expiration, how often would you, end up making or losing in the theoretical edge. Yeah, but with the benchmarks, it's different. It's just looking at the cost, what is the cost historically of this strategy, just using the implied volatilities, right? Is it high or low? That's what it's looking at.
Two different ideas.
Two different ideas. I don't want to mix them up because it'll get really confusing if I jump to that one.
My head's spinning just from the questions. This is another question. It would take you in the direction of unusual option volume, so I'll avoid that. But those were a good series of questions. We appreciate them all. Actually, Peter's recommending for the individual who's asking about, I think it was Venus, maybe asking about getting involved with options and learning. He was saying that the site Udemy has a lot of good free courses about options. Anything else you want to say to the crowd before we go? That is all the questions.
Yeah, I just recapped this. So, obviously if there's any more questions, you guys could email us. Maybe if I get a lot of questions, we'll follow up trying to like do something around the next batch of questions. But I think that covers it, our second time around. So
I did get another question just popped up on YouTube. We'd be giving something back to YouTube. You want to try it?
Huh?
I just got another question popped up on YouTube.
Sure.
From Deepak Gupta. He's asking, I'm seeing a sideways trend with an option. Can you go through a strategy that you may be able to do if you're seeing, say you were looking at something you thought was a sideways trend in SPY,
You mean like the stock is just kind of like bouncing around one
Yeah.
place?
Yes.
Sure. So I think just the first one that comes to mind, you could do like if you really think it's just going to sit in one place, and you want like defined risk. Let me just move this a little bit. So here a butterfly or an iron condor. So like an iron condor like this, this has defined risk. So basically what you're doing is you're selling an out of the money call, selling an out of the money put, and you're hoping that, the stock just kind of sits sideways and expires anywhere in between these strikes, B and C. And that's kind of like your, right, an iron condor, probably for a sideways trend. Iron butterfly, it's similar, except, then you have this peak. So if you have like a specific price that you think you feel really good about, that it's going to close around there, then, you could do like a butterfly where you're selling the put spread, selling the call spread in this situation, but that strike, that B strike, that's your starting point. Right, so you're selling a put and selling a call at that B strike, and then you're buying a wing at C and buying a wing at A.
All right. We got one more question I was alerted of that I didn't answer it from Wayne. He says he sees the long put tab. Do we have a short put tab anywhere up there, or am I missing it?
So yeah, let me just move it around. Let me see. Let me get to the long put. So the long put tab, you would just do the reverse of. So here's the long put, right? So this is the long put. So it's taking the midpoint. So the short put would be just the reverse. So here on a 30-day maturity, it costs you 2.6 to buy, you would receive 2.6% to sell. That's the average, 2.1. If you want, I think we did an out of the money one too. So here's like an out of the money, 5% out of the money. So at 5% out of the money, right now the premium is 1.2 versus 1. So it's just the flip side. Long, the short would be the reverse of that.
All right. Sounds good. I got that. Wayne, did you get that? We got some questions coming in. Do you?
All right, sure. Yeah, why not?
All right. Actually, this next question is basically downloading information. I don't want to go too far astray.
Okay.
All right. Well, that was a good series of questions. I thought it was a great.
Yeah, thank you for all the questions.
Interesting show, Dimitri. I really appreciate that.
Thank you, Will.
Any other tidbits you want to give everyone before we shut down?
I mean, no, I think that one thing we might be talking about a little bit later is we're going to be looking at historical stock behavior after like large gap moves in the morning or large moves during the day. So we're doing analysis like, well, historically, how did it behave, during that day, or how did the stock behave coming out afterwards, like the next day or so forth. So I think that that's probably going to be the next thing we might be talking. I think if we get it ready, it's still in the works. So if that's ready and you're going to publish it, that's probably the next thing we're going to be talking about is how the stock. Let me see if I could give you guys like a sneak preview.
Wow, you're gonna give the 100+ people on the show right now a sneak.
Yeah, let's see.
Insight into your computer.
Quickly. So it looks something like. Let me see if it's on.
Mike Chandler, I have to tell you, I haven't even seen this yet. So this is secret.
No, I don't have it. It's not ready, so I don't have it. I don't have it here to show you. So, but I have. It's still in our internal stuff, so I don't even have it on this version yet.
Well, I'll tell you, Wayne King just sent out a big thank you. He says these MC webinars are always worth watching and listening to. And
thank you. I really appreciate that.
Yeah, we
try to help.
It's good stuff. I know it helps everyone. We get emails all the time. It is very helpful for people to get walkthroughs of the Chameleon, and they particularly like it when you, King Chameleon, walk through the Market Chameleon site.
Thanks. Well, yeah. Yeah, I try to get we get a lot of questions now, so I can't even get to all of them, but I try to get to as many as I can, or the ones that questions that come up in common, I try to mention here. So we kind of go over them.
Yeah, well, that's great. Well, listen, anyone on YouTube, please click the subscribe button below. You'll get an announcement every time Dimitri launches a new video. Everyone who's on Zoom right now, also go to our site, and it's really important to get those videos when they go live, and helpful to us too if you register. So all is good. Dimitri, we're on, and our Sunday webinar series is moving to Mondays for the summer season. Is that correct?
Yeah, I think for the summers we're going to do them on Mondays, because I was getting a lot of comments that people can't even make it on Sunday, and a lot of people are going away, but they want to see them live. So I think we're going to do them on Monday nights during the summer.
Well, that's great. That works for us.
Yeah.
All right.
Awesome.
Well, thanks for doing this, Dimitri. Everyone, thanks for joining us.
Thanks, everyone.
Another good show. Everyone have a good night, a good trading week, and we'll see you next Monday.
Good night, everyone.
Bye, Dimitri.